Good afternoon, everybody. My name's Ben Kingsley. I'm the founder of Empower Wealth, which is a wealth advisory business that also handles information in regards to financing, so mortgage broking work, and we help mum and dad investors, and we also help people get into their first property. So that's what this presentation today is about. It's about how do we help our kids get into the property investment market and also the owner-occupier market as well. So let's start. Firstly, the information I provide today is factual in nature. You must seek independent financial advice. I'll put that disclaimer out there. And then this is what we're going to talk about today. The first thing I want to share with you today is the cost of acquiring property. So it's important to understand what it's going to cost, and then from there we can then work out the 7 steps in terms of how we will go about helping people get into the property market sooner. And finally, we'll finish off with some question session for those people who want some personal questions answered for themselves. So let's get into it. The first thing I wanted to show with you here is, let's assume we've got a $450,000 property that we're about to buy. In terms of the cost of acquiring that property, we're going to have the stamp duty, state-based tax and land title transfer fees, and that's going to be around that $21,000. In addition to that, we're going to have conveyancing costs in terms of being able to transfer the asset over. In addition to that, there might be some lender application fees as well. Now, those lender application fees could be complimentary as part of an overall professional package that you may get with your lender, or they could be a one-off cost that you pay to your lender. And so overall, we're talking around $472,500 as being the cost to acquire that property. In addition to that, there might be other fees that you need to consider, such as lender's mortgage insurance. So when you buy a property, and we're going to go through this a little bit more, but when you buy a property, the lenders are happy to lend 80% of the value of that, and it's the insurance companies who step in on top of that to allow the property to have a loan greater than that 80% figure. And what happens there is the insurance companies step in and the borrower pays a premium for the lender, and that insures the lender. It doesn't actually insure the borrower in terms of that, but we'll talk more about that in a moment. In some cases, it may be advisable to get independent legal and financial advice, so there's going to be potentially some costs associated with that as well. And today we're going to spend a bit of time talking about guarantees in terms of how we can guarantor for our kids in getting them into the property market. And then finally, when you buy a property, it's a significant asset. We want to make sure that we insure that asset in terms of how we look at it. So a great rule of thumb, and what we want to take a message away today is, if you want to calculate what it's going to cost you quickly in terms of cost, just use 5%. Now, if you're going to borrow more than 80% against that property, add another 2 or 3%. So the bigger the loan amount, go towards the 3, the smaller the loan amount, go towards the 2. Okay, so 5%. So if it's going to cost you $400,000, that's $20,000. If you're going to take mortgage insurance on, it's going to be around that sort of $25,000 to $28,000. So let's have a look at this example that I've built. This is a $400,000 property. So buying that $400,000 property, we've just learnt our 5% rule of thumb. And our 5% rule of thumb is the cost of acquiring the asset for those of you who are just arriving. So if we wanted to borrow a loan or do a loan to value ratio of 80%, then what we've got here is our loan amount is $320,000, which is 80% of the value of the property. Okay, so it's not 80% of the total, it's 80% of the value of the property. And in that case, we need to bring to the table $100,000 to settle on this property. Then, if we wanted to do a 90% lend, you can see something's changed here. Again, we've got a loan amount which is 90% of the value of $400,000, and then the cash we require has come down, but we've got a mortgage insurance premium. So lender's mortgage insurance estimate there of $7,000. Now, if we wanted to borrow 95% of the value of the property, again, our cash requirements have dropped now from 60 down to 40, but we've got an LMI estimate of around $13,000. Now, in some cases, lenders will allow you to capitalise that into the loan. Okay, so they'll allow you to actually add that to your loan amount. So you don't have to come up with $53,000. You only still have to come up with $40,000 because that amount will be added to your $380,000 loan amount. Now, when we talk about guarantee loans later on, I'll show you how we can get rid of that completely. So that's the cost of buying a property. All right, let's move on. So the question for all of you parents out there is, why do we want to get our kids into property sooner rather than later? Have you ever heard of this before? Whoops. Ever heard of kippers? Kids in parents' pockets eroding retirement savings. That means that we want to get them into their own property so they're less of a burden on us and get them out of our house, doesn't it? So kippers is what we call them, and that's why we want to try to get them into their property. So how can we help to get them into their property sooner? Well, here's 7 ways in which we can do that. The first thing we can do is teach them how to manage their money. Okay, so this is not a wow point, but it's just about making sure we understand that if they manage their money well, then usually we're going to be able to teach them how to save, and when they save, they'll have a deposit and they can get on that track. So what are the tips? The tips around bills and spending and around provisioning for future needs is all about prioritising what is essential versus what is, the discretionary stuff that we do in our household and in our own situation. In addition to that, we then work out what that monthly surplus is. And one of the best tips I ever had was from a book by Noel Whittaker when I read that at the age of 16, and he talked about paying yourself first. So a tip for your children is when they start earning their income is to tell them to go and put money so they don't even see it. So it comes straight from their employer and goes straight into a bank account, away out of their possession, and then tell them they've got to live on the rest of the money left over. Okay, and they will be able to save up a nice deposit fairly quickly. And we want that money to be put into a high interest savings account, but we want it protected. We don't want easy access to that money, because when we have easy access to money, as kids we're impulsive and we want to get access to it and we spend it. So that's an important one. Work that out, and then that's also a good way of working out what you can afford to repay. So in terms of working out your repayments, you can look at that surplus you've got there, and that's a good way of working out your borrowing power based on that surplus cash. Now, that one came up pretty quickly. Avoid other debts. Now, this is a message that I send to all good parents. The kids won't listen, but I'll send it to you anyway. The new car. They've got to buy a new car because they can't buy a second-hand car. For what reason? Oh, it looks better. So I would say to people, if you're looking to save money quickly and you're trying to teach your kids how to create wealth or get into their first property, that car doesn't have to be brand new and it doesn't have to be the latest model. It just has to be reliable and safe to get you to your work environment, to earn your income, or no car at all. So just make sure that we're not spending too much money or borrowing money for discretionary needs. Okay, we want to we only spend our money to create a need to move forward. Now, lenders will reward those who have actually saved well through what we call genuine savings. Okay, and genuine savings is a test by the lender and the mortgage insurer to say, have you been able to demonstrate your ability to be able to save money because you're about to take out a 25 or 30-year loan? Are you in a position where you understand that this is the commitment and it's a long-term commitment? And if they've proven that savings over 3 or 6 months, around 3 to 5% of the value of the property, then that's a genuine savings test that will also help them borrow money. So that's the first tip. Teach your kids money management skills. The second tip is a financial gift. So in our business, we've done a lot of these for our first home buyers where they've come in and said, my parents are giving me a financial gift. Okay, now, as far as the bank's concerned and the lender's concerned, that gift needs to be non-repayable. So in other words, it's not a loan. They have to gift that money. So an example would be we might have a young couple and one family member is going to gift them $20,000 to add to their deposit. And all we need from the parent is a statutory declaration to say that it's non-repayable. If we don't get that and the lender sees $20,000 hitting their bank statement, they're going to ask the question, where did that come from? And they say, oh, it's come from my parents. And they're going to say, well, is it a gift or is it a loan? And even if you say it's a gift, they want proof of that to be the case. Okay, so that is another great way in which parents can help get their kids into a property sooner. This one is by far the most popular growing way in which you can help your children get into a property. So I'm going to spend a little bit of time on this one, and it's called a parental guarantee. Okay, so it's where the parents provide a security guarantee on behalf of their kids to get them into the property. So here's an illustration, and it can be their owner-occupied home or it can be one of their investment properties. So here we are. Let's step through this illustration. So we have the family home over here, and then we have the new potential purchase by one of their siblings. Now, they may have a current mortgage or that property may be unencumbered. In addition to that, we're looking at getting an 80% loan, which the kids can service over here. We've got, remember we learnt earlier that the bank wants to retain around 20% equity in the parent's property. So we've got this position called equity. Okay, and it's this equity here that the lenders are looking for as security to help the kids get into the property. So what we see here is a loan that we get from that, and that's at 25%. And the reason why you separate those two out is over time the value of that property that the kids are going to buy will eventually mean that the loan to value ratio will drop to 80% of the overall value. The moment that happens, then we can release this and we can release parents from that limited guarantee. Okay, so when we release that, the parents no longer hold the guarantee. And so when you're talking to your lender, make sure you ask them, is it a full guarantee or is it a limited guarantee? Because with the limited guarantee is a better one for you, because the moment that this loan to value ratio hits 80% as the value grows and they retire the debt, then we want you to be released of that obligation, that guarantee obligation. So earlier we saw this sort of thing happening. Here's our 5% costs, the 20% deposit for the guarantee, the 80% loan, which is 105%. So we're getting a total loan of 105%, but the child is actually servicing that loan. Okay, the parents can't be parental, they can't give a servicing guarantee, they can only give a security guarantee. Now prior to the GFC you could give both. Okay, but since the government's introduced regulations around responsible lending practices, the regulations don't allow for responsible lending if the parents are kicking in on an income basis. Okay, so they can only kick in and support them on a security basis. Okay, the kid still needs to, your child still needs to support the servicing of that full amount of money. So let's go back and have a look at what that means. So parents will help their kids having to save up a partial deposit for the purchase of the property. So these are the benefits. They can also ensure that the child doesn't pay mortgage insurance. And of course they can get into a property sooner. So let's have a look at this example. So before we had the illustration of the $400,000 property at 95, and you can see that was the cash that was required by your child, and that was the lender's mortgage insurance. If we do 105%, there's no cash required and no LMI paid. So you know when you're going to get hit up with this, parents, okay, all you parents out there, it's when the kids say, come on over, I've cooked a nice meal for you, okay, I've got something to talk about, I want to basically ask you a favour, can you save me $13,000, mum and dad, by going guarantor of my property? Okay, so just remember that's when you get a really nice Christmas gift that year, because you're helping your kids get into the property sooner. So that's the message. You can get them into the property sooner. They don't need to save for a deposit, so it's a really good message for them. And guess what? You can get them out of the house sooner. So that can also help you out as well. So from a legal perspective, whenever you're signing any type of guarantee, you need to understand what your obligations are. So I've taken the legal jargon out, but effectively it's make good, meaning pay back. So if in the event that your children fail with their obligation to meet their repayments and the property is sold and it's sold for less than what the bank gets as their money, you've got to make good that conversation. Okay, so there is a risk. We need to understand that. As guarantors, we need to understand our risks. It's about making good on that. Okay, so, and most lenders will usually ask the guarantor to get independent legal advice so they know what their obligations are, which is a good thing, okay? But it's definitely one of the fastest growing areas of parents helping their children get into the property market sooner. In addition to that, tip number four is the family loan. So we can see here, here's the parents. They can give the loan in terms of a piggy bank, so out of their savings, or they can actually go and get their own loan from the bank and then lend that money to their kids. Okay, so this is actually a formal loan whereby the bank is going to assess the servicing capability of your child based on this being a loan as opposed to being a gift. So it can affect their borrowing power, but it's a way in which you know that your money's going to come back to you as well. Okay? And if you're going to do something like this, it's always handy, especially if they're in a relationship and you're not quite sure about the partner, to make sure that there is a loan obligation that all parties sign, and then you can make sure you get your money back. So that's point number 4 in terms of getting a family loan. The fifth one, and we're seeing a bit more of this trend happening, is the kids. Instead of kids are joining up and they're saying, well, let's buy one together. Brother and sister, 2 brothers, 2 sisters. And what we can do there, the benefit is we can combine our income and we can also combine our savings, and we can go and buy that property ourselves and live in that property together. Now, joint ventures, we sometimes see in our business several people coming in and saying, oh, 2 mates joining up and they're saying, we want to do this ourselves. And we say, you know, do a joint venture. Now, a lot of joint ventures that I've seen tend to go a bit pear-shaped after about 5 years, because one of them might have met the new girlfriend and now they want to get into their own place, and you know they're caught in this joint venture. So just make sure that if anyone's going into any of these types of joint ventures, whether it's brother, sister, or 2 mates, or a couple, whatever it may be, that we have an arrangement in place that says, usually my tip is, for the next 5 years, this must remain in place, because it costs a lot of money to get into property, and if we need to sell it in 2 years, we could lose money. So I always say for any of these types of ventures that you've got to be committed for 5 years, and the terms in the contract should read that if one of us wants to get out, all we get out is the money that we put in, so we get no other value. So it really does lock them in to making sure they fulfil that minimum 5-year commitment. Okay, so that's an important message there. So that's the siblings doing it themselves. So the benefit is they can combine their incomes and their savings again. The 6th one is that joint venture. In this case, though, it's the child, the daughter here, and then the parents getting involved. Now, the reason why the parents get involved here is because if they are taking an interest in the property, then we can use their income as part of that servicing. Now, so if you're sitting back saying, well, based on what my daughter earns, she can only borrow $200,000 and to add to the savings that she's made, but we really wanted to get her to a better suburb in a better location, which probably needs that she needs to borrow $300,000. Now, we're pretty confident that she's going to have income capacity earning because she's just finished uni and her income's going to grow pretty quickly. So in the start, we're going to take a 5% interest in that property because we can help her with servicing the loan. And then when she's in the ability to control and service the property by herself, the parents can sell their share down. Okay, and they only pay the stamp duty on that 5%, or it might be 2%, or in some cases it might be 1%. Okay, but they're taking an interest in the property, and that allows the parents to use their income to help her borrow the suitable amount of money that she needs to get into the market. Okay, so that's point number 6. The other one, coming back to the Kipper's point, again, kids in parents' property eroding retirement savings. So in this particular case, what's happened is these very, very kind parents are saying, don't leave us, honey, don't leave the nest, stay with us and invest in property. Okay, and so the parents are quite happy for her to stay and look after the property whilst they're travelling through Europe, to look after it, so she can stay at home, live off them, but also then look to get into the property market. Now, the benefit of doing that is that she's going to have the tenants also helping her with servicing, so it increases her capacity to borrow and also service the loan. Okay, so, and potentially there might be some tax advantages as well based on her circumstances. So the reality is we're seeing a bit of this happening, whereby kids are staying at home and they're getting on the property ladder by investing first and then one day buying their owner-occupied property into the future. Now, the last 2 slides that I brought up there, which was the parents buying an interest in the property, and in this particular case, there might be a question around first homeowners grants. Now, the current regulation around first homeowners grants is that if this daughter was to buy this property and never move into that property, then technically when she does ultimately buy her owner-occupied home, the grant is still available to her. Okay, so just because you own an investment property doesn't mean you forego your grant. Okay, however, in the previous example whereby the parents took an interest in the property, you do forego, and you're going to live in that property, you forego your grant. Okay, because one of the questions on the tests to pass for the grant access is that, has anyone ever owned a property and lived in that property before? Well, the parents certainly do own a property and they've lived in it before. So they wouldn't be able, she wouldn't be able to get that first homeowners grant. Now, that's current legislation, and this legislation is a state-based legislation, so it can change from time to time. So just because it is. So I take the view for the $7,000 grant, and there's also some stamp duty concessions as well in some cases. Don't make your decision on getting into the property market because of $7 grand. Get into the property market because you've got a need to get into it to the long term, and you're getting a foot on the ladder to get into the property market. So it's absolutely important to understand that. So some people are going to use this as their means to get into the property market quicker. So that's pretty much it in terms of the 7 points. Now, we've produced an information guide that's available to you, and inside our brochures on the chairs there, you'll see a little, and it's the Empower Wealth brochure, you'll see a little yellow form. If you want a free copy of that first home buyer's information guide, just simply fill out that yellow slip and hand it to one of my team members or myself at the end of this presentation, and we'll be delighted to send that out to you. In addition to that, I'm also going to be recording a webinar talking about the process as a first home buyer to get into the market. So we'll be recording that over the course of the next couple of weeks, and we'll send that out to you as well if you give us your details. Do I have any questions from the audience? Yes, sir.